Hey, business owners, we know you know the importance of maximizing every dollar. With the Delta SkyMiles Reserve Business American Express card, you can make your expenses work just as hard as you. From afternoon coffee runs to stocking office supplies and even team dinners, you can earn miles on all your business expenses. Plus, you can earn 125,000 bonus miles for a limited time through October 29th. The Delta SkyMiles Reserve Business Card. If you travel, you know. Minimum spending requirements and terms apply. Offer ends October 29th, 2025.
Reality radio for a really great future. We're talking real money.
All right, let's start with something old-fashioned. Something old before we get to something new, and then borrowed and blue later. Tom be borrowed, I'll be blue. 855-935-TALK is the old-fashioned thing. That's called a phone number for those of you of a younger age. What, my level? My level's fine.
Okay, sounds low.
To you, but not to everybody else.
Okay, well, that's all that matters.
Yeah, turn your level up.
My level's loud, I can tell.
Yeah, no, my level's fine, right, Rich?
All right, you keep going. I didn't mean to interrupt you.
You did. You interrupted me. Now I have to find out if it's all right with Rich. He's not listening.
He left.
He's watching the Oregon.
You're fine.
He's watching the Oregon game.
You're fired or you're fine. I don't know which one it is.
I'm fired. Hey, hi, 855-935-TALK. How did I get so distracted so quickly?
I apologize.
I blame him.
I should.
And he is wearing blue, too.
I know.
Mm-hmm. Call us if you have a money question. There, that's what I was going to say, but I didn't have a chance. I was going to say that.
You had a really nice open, and I messed it up. Just go back and do it again.
No,
like you never did it again.
No, you can never go back.
You never did it before.
No, you can never go back. You can't go back.
That's kind of sad.
It's too late. We got to move forward. We got to just keep pressing on in a forward direction. What was I going to mention? Oh, when it comes to interest rates, there's a great deal of misinformation and confusion about interest rates. Some people think that when the Fed lowers rates a little bit, like they did recently, where they dropped the overnight borrowing rate at which banks can borrow, they dropped it by a whopping 1/4 point. Something magical is supposed to happen. The stock market is going to have a little magic pixie dust sprinkled over it. It's going to sprout new profits. Interest rates on your mortgage will suddenly plummet. No, your credit card rates will go down. No, that's not what happens. The Fed tweaks rates a little bit to do one thing and one thing only, and that's they either increase the rates to try to slow the economy down just a smidge by making money more expensive, or they lower rates to make the economy perk up when unemployment is rising. And what they did recently, apparently, was in reaction to unemployment numbers not looking great, and so they lowered rates. But what was the impact of all of that? What is the impact of that on us?
Yeah, and just by the way, between the two of us, my overnight rate to you remains the same. It's not. Yeah. I didn't change it, so give me a call Monday. We'll talk.
It's non-existent. It's not happening.
Exactly, it's not going to happen.
I go to the Fed window, and they go.
you get step away from the window, sir.
Yeah, get away.
And
they put up one of those signs that says "next window," and then the next window puts up.
So, because you would think that the 10-year Treasury note. Mm-hmm. would go down. You think the 30-year would go down, right?
Yep. Yeah. I would. No, I wouldn't think that, but they would.
I know. But both went up. Mortgage rates really didn't move too.
They went down very little.
But then they went right back. They started the week at about 6.2, and they ended the week pretty much at 6.2 for a 30-year fixed rate. So not a whole lot of change there.
But why? And of course, why? Let's talk about the
because
why.
It doesn't because people think there's a causal link between the overnight Fed rate and what you're paying for mortgage, as you said, consumer loans, credit cards, et cetera. There is not.
Is that though because there is it's either a misunderstanding or a lack of information, or I believe it's in large part due to the fact that most people believe there is some wizard with knobs who sits around and decides what the interest rate's going to be at any moment. Ooh, I think I'll tweak them a little higher.
Well, that's closer to the truth, by the way. There are many wizards that are trading things back and forth.
But wait, by many wizards, you mean approximately how many wizards?
Well, I'm not allowed to say because they're wizards, but because it really does come down to people trading. It's
okay.
It's
so you're talking hundreds of millions of wizards,
lots and lots of people. Yeah. And by the way, for those of you playing at home who are thinking about that, you mentioned the future. The Federal Reserve is projected to have rates, the overnight rate at about 3.5% by the end of 2026. But here's the part that's interesting. The people that are doing the investing and trading, they believe rates will be at 2.8 overnight rate by the end of 2026. That's fascinating. So
really,
all the things
wait, you actually find that fascinating?
I do, because there's a delta there, a difference.
So it's all a bunch of guessers.
Yeah, it is. And here's the thing about the aforementioned mortgage rates. The 6.2 that was already built, the reduction in that overnight rate was already built into the 6.2. So therefore it did not come down. It anticipated. That's the thing people forget about investing in a big picture sense, that those things are already built into it.
That's what happened with the stock market. There was this expectation that, the minute the Fed announces a rate cut, we're going to see a big spike in stocks. We didn't. It had been happening because it was anticipated. It was expected. The Fed signals, rarely surprises. They usually signal well in advance because they don't want to surprise. Because, for example, if they had to raise rates a lot, they don't want that to cause the market to crash in a day. They're going to signal that they're raising and let the markets adjust over time to that new, more expensive money scenario.
And we'll talk in a minute about whether you should be drinking in these new interest rates and what this really means to your money.
God,
I think you're going to be interested in this.
God, he loves puns. He really does. It's just, oh my goodness. Or if you could preempt that if you call us at 855-935-TALK.
Don and Don are talking real money.
Hi, Don McDonald here. So, what's your plan for retirement? No, really. What's the actual plan? Because hoping the market goes up, stockpiling random investments, and praying your gut instincts are smarter than Wall Street is not a plan. It's a guess. And when the market gets bumpy, and it always does, guessing leads to second guessing. And second guessing leads to panicking. That's why you need more than a portfolio. You need a purpose, a strategy, a real financial plan built just for you by a 100% fiduciary advisor who's legally obligated to act in your best interest. Imagine that. Start your plan today with a free, no-pressure meeting at TalkingRealMoney.com or call 800-386-3004. That's TalkingRealMoney.com, because your future deserves more than crossed fingers and wishful thinking. By the way, no sales pitch, no obligation, just smart help for real people who want to stop guessing and start planning. Appella is an SEC-registered investment advisor. See AppellaWealth.com or the firm's Form ADV for more details.
Your guides to a really great financial future. Tom and Don are talking real money.
Much of what we do involves talking about investing. And that's why you'll hear, because you're trying to build a future, and investing is how you get there. So generally speaking, you hear us talk about a lot of mainstream stuff, like we were talking about bonds before the break. Bonds are boring. Supposed to be boring, supposed to be dull. They don't fluctuate much. They pay interest. And the yield on bonds historically has been in the 4, maybe 5% range, somewhere in there over time. Lately, right around 4, a little over 4%, right?
Yep.
4%-ish.
Still paying about that for good bonds.
However,
they'll pay you back.
However, folks are always looking for that other thing, that alternative investment, the one that might give them a little bit more return and even, I hate to say, excitement. And that leads people to invest in, gold and crypto, but also
for sure,
collectibles, cars,
alternatives,
art,
oil,
and
land.
And a lot land, like farmland.
Mm-hmm.
How's that going?
How's my farmland?
Yeah, how's your
farmland? Actually, for the first time since I invested in that, what has it been, 5 years? It went down last 6 months. It finally went down.
It's not publicly traded.
I went out and checked. I checked the temperature and stuff,
okay.
and measured it. It's a little less than it was. So,
but among wealthy people, particularly, a popular investment has been wine. There was an article.
Not the type that Don does on the show a lot. This is the type you can drink.
Yeah. Bottles of wine, fruit of the vine. When you gonna let me get sober? So how has wine done as an investment? Well, we decided to do some research and look into it.
Yeah, it's ripening. I think you could pour it on, really do.
Well, it turns out wine's the average annual gross return, and it's important that we start with the term.
But let's go back. How do you invest in wine? You either invest in a winery, right?
No. You buy cases of wine.
Okay, so you're buying a case of wine, you're putting it in your basement, and
that's the
not
problem.
If
If you don't store it properly, your investment can sour.
Because there's stories where there's people
literally can sour.
Exactly, it's gone south. So sorry.
So it has to be stored in very special conditions, and for those who are big wine investors, that means storing it in facilities designed specifically to store fine wines.
Yeah.
So you buy the wine through a dealer or an auction. You store it in a warehouse. Most wine people have to add some insurance because you got a lot of risk with wine. I mean, like, what happens if somebody drops the case?
Or the place sets on fire.
Or something like that. Yeah, so you got that. And then when you sell it, you got to sell it through a dealer or an auction.
You got to pay them.
So the average return on wine has been over the last 10 years about 8 to 10%. It's hard to nail down because it's not a real precise market.
This is on buying and selling actual wine, not investments in wineries.
Right. This is like the Burgundy Index is up 9% per year.
The
Italy Index, the Italy Wine Index, about 5.5% per year. Gross. This is pre-cost.
Not real return.
The costs turn out, it's some research, the cost of buying wine, the purchase and markup, it can be between 10 and 25% both ways, getting in and getting out.
There's some commissions.
Storage and insurance can run you up to $30 per year. And when you add all that up, and that doesn't count taxes and transportation and spoilage and all that stuff, when you add all that in, wine has delivered about 4 to 5% returns after expenses. Now, what does that
before inflation?
Oh, before inflation, yeah.
Okay,
yeah.
So like 1%.
What does that sound a lot like? We just mentioned it earlier in this segment. What yields 4 to 5%?
I think land.
No,
real
bonds.
Estate. Bonds. Pardon me. Well, you can see why he struggles.
This is not his day today. This is not his day today.
I'm going to go back, take 2 more 5-hour energies. I'll be back in a minute.
You remember that dumb pill we referred to earlier this week?
I popped 2 this morning. Feel great.
Anyway, what it turns out, and this is going to be the case with so many things that sound exciting, that are
well, they are exciting. It's exciting to invest in wine, sure.
But the reality is, if you invested in a stock and bond portfolio, just 60-40 boring stuff, you would have made over the past 100 years 7-8% per year on average.
Yeah.
So which would have been better? I mean, you made so much more in stocks and bonds that you could afford to buy the wine and drink the wine.
So you're saying wine as an investment, put a cork in it. That's it.
Right, put a cork in it. Okay. Invest in stocks and bonds and drink the wine.
Drink the wine. Yes,
drink the wine.
Are there publicly traded wineries you can invest in?
Well, I'm sure there are. I don't know.
Robert Mondavi or Ernest Gallo or something like that.
I once interviewed Robert Mondavi on my show when I was doing it from Disney World. Nice guy.
He dropped by to...
He was there for a Disney event, and they said, would you like to talk to Robert Mondavi? And I went, yeah. Sure. I mean, what interesting
done pretty well
guy.
For himself.
And it was not long before he died. So it was nice to...
hoping there's no causal link there, but...
Let me just see if there are any. I'm checking. Hold on. I'm checking to see if there's any, because I know you're dying to buy in now.
Oh, yeah. I'm all in. Since the land thing barely is working out. Yeah, I think I'm ready to go.
Yeah. Okay, good. Okay. You nailed this. There's a company called Constellation Brands. They own Mondavi, Kim Crawford, Ruffino, some really good, good mid-tier wine. I don't know.
All right,
they're on the New York Stock Exchange. Okay. And there are others. Willamette Valley Vineyards. We'll be right back. 855-935-TALK.
Tom and Don are talking real money.
Tonight, turn down the noise of the day and focus on the rest with AGZ, the nightly drink for winding down and resting up. New from AG1. AGZ supports your body's natural sleep cycle with clinically studied key herbs, adaptogens, and minerals in amounts supported by research. And no melatonin, helping you wake feeling rested. Wind down, rest up with AGZ. Learn more at drinkagz.com.
For your real life and real future, Tom and Don are talking real money.
Got questions about your wine collection? Give us a call. We're not going to have any answers for you on that.
Oh, yeah, we will. My brother used to be wine steward at one of the finest restaurants in Seattle. So, yes, we will have answers. They won't be the right answers.
You're not him.
I know. And he quit to become a lawyer and talk about career suicide hotline. I mean, one of the great mistakes of all time. That was really awful.
I seem to think I seem to
Smart
recall
guy,
he did better since the wine steward thing, didn't he?
Okay.
A little?
Fine. They sent him on all these trips to Europe to drink all this wine. That was his job.
That is kind of nice.
Really?
855-935-TALK is our phone number, 855-935-8255. Because Tom was curious, and I think this is fascinating, it actually ends up being something that we will enjoy sharing with you. How has Constellation Brands done, this wine company?
How long have they been publicly traded?
Oh, long time, since the 90s. But let's just look back 10 years. Because they started trading in 86. So a long time ago. But let's just go back 10 years.
Okay.
10 years ago, the price of STZ, Constellation Brands, in September of 2015, was $127 a share.
Yep.
Okay? This is a lesson, individual stock lesson for you.
Yeah. Thank you.
This
apparently I need a lot since I took two
soared up
127.
It soared up to $230 just 3 years later.
Wow. So almost a double.
Oh, but wait. Then in 2020, 2 years after that, it dropped to $120.
Because no one's going to drink wine during COVID? You think drinking wine would have gone up?
Exactly.
Isn't that weird? Home with everybody, give me another glass.
But wait,
I don't know.
There's good news.
Okay.
By April 2024, it had shot back up to $261 a share.
By when? What, say the year again?
April 24, just less than a year ago.
So if you hung on for
more than
years,
double.
You got to double.
But 9% a year.
Look at the risk you had to take. You had to take a lot of volatility.
You want to know how much volatility? How about the price today? Right now.
I should have looked this up.
$132 a share.
Wow. That's crazy.
It lost half of its value since April. There is a lesson. This is a great object lesson.
We all need to be drinking more, apparently. No, that's not the lesson?
No, the lesson is look at how flippin' volatile individual stocks can be. And yet if you held it long term, you made you're 10 years later you're at break even.
Well, 10 years, yeah. Well, that's right. Now you're still right back up.
127 to 132.
Here's the other lesson. Frankly, if you're going to buy a sin company, better to buy the cigarette Altria. Isn't that one of the best performers over the last 100 years?
Yeah, it was over 100 years. So I don't know how it's done recently.
I don't know either, but it's
now you've piqued my stock curiosity. So let's just look at 10 years. Let's look at 10 years. Let's go back to September
2015.
2015, $55, $54 a share.
Yeah,
54. Then it soared by 2017 to 77. That didn't really soar, but it went up. Since then, dropped down to as low as 34.
Wow.
In 2020.
Went up in smoke. You can literally say it.
I knew that was coming.
That's too easy.
It went up again, then it went back down to 40 by 2023. And today, it's $64.89.
So we can safely say, do not inhale, I think, right there.
Okay.
No?
Okay.
Take another 2 pills is what you're telling me.
Yeah. How much worse could 2 more pills be, really?
They can't. That's the thing.
I don't even know where to go with this now. Basically, okay. The point I'm trying again, and I think Altria makes the point again.
I agree.
Holding it, if you bought it, in September of 2015, you went, "I'm going to buy the big tobacco stock." Because I'm a contrarian.
They do stuff outside of tobacco, of course. They're a huge company.
No, they sold off all their other stuff. No.
I thought they had a bunch of other things.
They did. They had Kraft and all that stuff, and they spun it all off. And Altria. What
about Helix?
That's a tobacco thing. That's inhaler, vaping.
Okay, sorry.
They're all nicotine delivery.
Don't they have a stake in AB InBev?
And alcohol. They're all sin stocks. They do have a stake.
Sorry,
they do have a stake. They don't own AB InBev, but they own a chunk of AB InBev. Right. But again, I'm going back to the lesson here. It's hard to pick winning stocks over a long period of time. The only way you're going to win is if you trade, and you're never going to know the right time to be in nor the right time to be out. 855-935-TALK. Call now.
Tom and Don are talking real money.
This episode is brought to you by Amazon Business. We could all use more time. Amazon Business offers smart business buying solutions, so you can spend more time growing your business and less time doing the admin. I can see why they call it smart. Learn more at amazonbusiness.com.
Reality radio for a really great future. We're talking real money.
Welcome
back. I don't
back.
want you to whine about it anymore, but you were right about
still
that.
Here.
I'm sorry. Well, I left in the door. They didn't lock the door. But I did want to finish your thought, which is very good, the volatility. But the other part of owning individual companies is, as Professor Bessembinder found, a very small number of them actually make you anything over the long haul, right? I mean, it's a very small number that do better than T-bills, I believe. It was
like 4%.
So you got to pick those first. Then you got. And I have
to tell you how proud I am of you for not saying Bessembinder.
That's your job. That's not mine. So, anyway, you could go look at all his work is up online, Professor Bessembinder, just as it sounds, and you can read it all if you like. So, study up if you're a trader.
855-935-TALK. Please call. Please call. Thank goodness some people during the course of the week don't get a chance to call, but they go to talkingrealmoney.com and then they go to the contact form, and guess what they do? They help us out by sending us real live honest-to-goodness questions, which Tom then prints on chunks of dead trees and reads on the show.
I have a lot of trees here.
Like he's going to do now.
Yeah, I do. And the reason...
What?
These trees could very easily fall on me in the next windstorm.
So you got to turn them to paper.
I think we do. Yeah.
I don't know. I don't think these trees compare to the trees you had at your old house. Those trees
are way bigger.
These are bigger.
No, these are way. Oh yeah. Wow. These are 100-year-old firs here. These are big trees. Yes. One of those falls. Good night.
Yeah. Okay.
Hillary from Wheeling, Illinois. You ever been to Wheeling?
Wheeling, Illinois.
I don't think so.
I don't think I have. I don't even know where that is, so I'm going to have to look it up.
Hi, Don and Tom. Recently purchased a home. Congratulations. Through a series of issues, ended up needing to pay cash instead of getting a mortgage. This ate up about half of my brokerage account, but once the old house closes, I'll be able to replace most of that money with the proceeds from the sale. Mm-hmm. While this has been a hit on my 2025 taxes, it gives me a chance to look at my portfolio and make changes to where each asset class is held to without worrying about having additional taxes. I've been using Paul Merriman's 10-fund ultimate buy and hold strategy. I want to make sure I take this opportunity to put each asset class in the best location. She has 70% in taxable, 20% in Roth, and 10% in HSA. So no pre-tax money, which is very unusual.
It is very unusual. And by the way, Wheeling is a northern suburb of Chicago. It's right along the forest preserve there that runs all the way north and south there.
Where
Chicago
all of our folks
area.
just gathered last week. This is an interesting question, and this does come up. I don't know, and we tell people, yes, asset location is important, right? Roth should have the riskiest thing.
Yeah, it's important. It's not critical, but it's important.
No, if you can, Roth would be the riskiest asset classes. That could be emerging markets. That could be international small cap value. Could be U.S. small cap value. Those things, sure. But that's only 20% of your portfolio. 70% is taxable. Now, because you have no pre-tax, she didn't say what she wanted her overall asset allocation to be. That'd be the first decision, right? How much in stocks?
Right, and that's a decision that really comes from the whole process of identifying your risk profile, which is a combination of risk tolerance and risk need.
Yeah, so you got to do that first. Then you would decide where those bonds, because really, if you can avoid it, although it's not horrible, you try to have the bonds in the pre-tax rather than the taxable, if you can avoid it.
You don't want bonds in a taxable account, and if you're in a high bracket, well, then you want your bonds in muni if you have to have some in your taxable account. You want them in.
But there's another thing we've run a lot of 30%. I mean, you got to be making.
No, we just had that study.
Yeah,
there was a recent study from
said,
I think it was from the Journal that said that intermediate tax-free bonds actually make sense down into the 20s.
Okay.
So
it's
might be something worth
gray,
looking into.
I'll put it that way. But yeah,
it's not sharp.
But if you could, if you can, yes, bonds in pre-tax. Riskiest things in Roth.
The other thing, though, that I think has flipped the equation a little bit is the advent of ETFs. I think
makes it better.
That has flipped because it makes then owning more aggressive equity portfolios in taxable accounts more palatable because they tend not to distribute income dividends, and they generally don't distribute any capital gains distributions. So as you're owning that small cap growth fund or small cap value fund, most of the increase in value is doing exactly what it does in an IRA, a regular IRA, except with the added benefit of that tax deferral being treated as a capital gain, a long-term capital gain at the end of the term. So I really think the rules need to be the rule of thumb needs to be adjusted a little bit to take that ETF effect into account.
Okay. So what you're saying is it gets grayer now between taxable and
grayer.
IRA, standard IRA.
And that's why it really
we
does.
can make the argument, though, for Roth that really should be aggressive in that as you possibly can.
Well,
because you get tax-free growth.
Right, but again, you get the tax-free growth, so that's a big benefit. But for most people, Roths aren't the bulk, and they will never be the lion's share.
Never's a long time.
Yeah, but
if you're a young person and all you've done is save in Roth from 20 till 50,
for
our
audience, very unlikely. But for younger people,
our Roths are tiny.
Maybe.
But then there's the HSA, Health Savings Account, which is basically a pre-tax.
It's like an IRA
account. It's like an IRA. But this is a mistake I see people make. It should have some amount of fixed income or cash, because you may need to take money out of that to pay the bills.
Exactly. And the benefit of doing that, if you take money out of that to pay the bills, there is no tax hit.
Correct.
It's tax-free. It's like if you use the money to pay medical bills, it's more like a Roth. If you take the money out later to spend elsewhere, it's more like a regular IRA. So it's kind of the best of both.
Yeah.
But you need liquidity.
The answer to your question, Hillary, is aggressive in the Roth. I guess a combination of bonds and stocks in the taxable and the HSA, in my mind, has some money market component and then a balanced portfolio.
And apparently it's a sunny day in Seattle, so give us a call from elsewhere.
Tom and Don are talking real money.
Disney's Lilo & Stitch has finally landed on Disney+. Now you can watch the global phenomenon at home with your Ohana.
Be good for 1 second.
Lilo & Stitch is verified hot on Rotten Tomatoes with an audience score of 93%.
Perfect.
Stitch is also cute and fluffy.
Disney's Lilo & Stitch, rated PG, now streaming on Disney+. And right now, you can get Disney+, Hulu, and all of ESPN with an incredible limited-time offer. Terms apply.
Your guides to a really great financial future. Tom and Don are talking real money.
Well, you're certainly making it easy on our production staff back at the studio so that they don't have to answer the phone and can continue to watch the Oregon State game without interruption.
The Duck Bowl?
The Duck Bowl?
No,
Yeah.
what's the name? I forget.
I don't know what the
organ.
name is. It
It'd
can't
be
be the
Civil War, the inappropriately named Civil War.
Inappropriately named Civil War.
Yeah,
I say that as a native Oregonian.
Okay.
Oh, okay.
Fill us in on the history of that.
Yeah,
So
it's
thank
good to
you.
know. So, so that's what he's doing. He's not answering the phone because,
Nope.
well, he doesn't have to because you're
Nope.
not calling 855-935-TALK, 855-935-8255. But Tom has so many questions. He's a great resource at moments like this when we don't
I'm
want
not
to
a
talk
great
about
resource all
wine
the
or
time?
bonds anymore.
Oh, I see. We could talk about,
No, let's not.
Okay, I was just looking.
Did you have something else you wanted to add? Some other
No, I
bad joke about drinking your investments?
You can't drink your bonds. Okay.
No.
So you want a question? is what you're saying,
Although,
basically here.
no, never mind. I'm sorry. I was going to go somewhere I
you
shouldn't
want a
have
question
gone.
Here?
Yes, I want a question.
Like
Unless
one
you
of
have
the ones
something
that they
else.
sent in. Unless you want, just go to the question now.
Oh my
what you're
God,
saying.
you're doing a Monty Python bit. He is. He's
Warren-
doing the bit from the castle in the swamp.
That's the last movie I liked. Warren from Waterford, New York.
And ladies and
writes
gentlemen,
this-
he may look like he's in his 60s, but he acts like he's in his teens.
I think that's true. Let's see. Question. He says, I bought a couple buffer exchange traded funds with a 15% downside protection.
Yeah.
Do you think these would allow me to increase my stock allocation since these ETFs lessen my downside risk? So, interesting. When I got this question, the same day, the Wall Street Journal wrote a big piece calling about these buffer funds, calling them. The headline was, "Are Boomer Candy Funds empty calories?"
Boomer Candy Funds.
Boomer
I love
candy,
that.
That's what they come. Yeah, because the idea is that you don't go up as much, but you don't go down as much, right? When you own these. I mean, to me, it's like a balance fund, but it's more sophisticated.
It's more sophisticated because they're using
more
options to
expensive,
provide
too,
a
by the way.
buffer. And compared to most equity ETFs, I mean, you got equity ETFs that are aggressive and do things that cost half of what no more. According to this article, buffer funds typically cost between 0.5% and 0.8%. Yeah, I'm looking at the cheapest one that I could find, which was MMAX from iShares, which is only 50 basis points. But
we're not supposed to say base. Didn't you do a podcast about this yesterday?
I did.
Got mad
I
at you
did.
for saying
I
basis
did.
points.
I did.
0.5%. Yeah. So that's what a buffer fund is. We don't advocate them. We don't use them. I would rather see you balance between stocks and bonds, keep it simpler and keep it less expensive.
Yeah, I mean, okay, let's talk about buffer funds for a minute. Because what they are is a Wall Street invention designed to give you something that you can get other ways, and that is protection against losses. You could do it with a balanced fund. But they do it, for example, the iShares large one, the cheap one. They buy the S&P 500, their own ETF. They own the S&P 500 ETF. And then they have a bunch of cash. And then they buy some options. And they're going short some options. And it's all these complex strategies that accomplish pretty much the same darn dumb thing or simple thing that a balanced fund has accomplished for over 100 years. So...
And they're more expensive.
No, I'm going to say stop with the buffered fund. That's going to be my response to this caller.
Well, I'm hoping I see one when I go to Hawaii later this year, but...
A buffered fund?
Puffer fund?
I don't even know what that means.
Puffer fish, puffer fund?
See, that joke was such a stretch that I think the entire audience went, well, he did take a dumb pill.
The take from the Wall Street Journal. You're killing me.
The
take from the Wall Street Journal is, their quote is, that depends on the customer. Someone able to grit their teeth and hang on during market swoons is needlessly harming their returns. Anyone who can't stomach volatility might cost themselves more by dumping their stocks at a worse time. Sure, it would be cheaper to pay someone a few $100 to hide your brokerage account password, but it's probably a tougher product to sell. I kind of like that close. Yeah, so I would prefer to see you just balance between stocks and bonds. So what his question really is, well, since I own this fund and it is...
No, I still would say
protection,
no.
Yeah.
Don't own that fund and then just own the right allocation of stocks and bonds. Sorry.
Can I go one step further?
Yeah.
Because I just reacquainted myself with somebody I knew 50 years ago who's been all in cash and CDs for 50 years.
Yeah.
And is now telling me, I think I should, put stocks, blah, blah, blah.
Oh, yeah, because they were afraid from the last big market decline. Yeah. Mm-hmm.
Yeah. And I think, no, not everybody. Sorry, not everyone can take the ups and downs. And there were grown men crying that I knew in 2020. You probably don't remember who that was, but in the spring of 2020 when the market went down.
I do.
And people called me crying because they thought this was the end of the world, never going to come back.
Look, we came back, folks.
Yeah. So no, I wouldn't use this product. And so the question is null and void. We're not going to answer it. Because
we answered it. I said, get rid of it. Okay. Let's go to Arlington, Washington. And Pat, welcome to Talking Real Money.
Thanks, Pat.
Hi there, Patty.
Hey, thanks for calling. What's up?
Hey. Okay, so I have an emergency fund, and I want to put it somewhere, but I don't want to get a 1099, to make some money, but I don't want a 1099 at the end of the year because my husband's, it might be close to the and so is there somewhere safe that will give me money, but I don't get a 1099 at the end of the year?
So make money, but no record
you
of
stopped.
it. Yes.
You stopped. I was going to say, there is a place to put it where it's safe. It's called in a safe, but it won't pay you money. No, it is required by law that everybody who pays you interest or makes you money on your money, unless they're doing something illegal, must file a 1099, must report that income, and then report it to you, and you report it to them.
Tom and Don are talking real money.
This episode is brought to you by LifeLock. Between two-factor authentication, strong passwords, and a VPN, you try to be in control of how your info is protected. But many other places also have it, and they might not be as careful. That's why LifeLock monitors hundreds of millions of data points a second for threats. If your identity is stolen, they'll fix it, guaranteed, or your money back. Save up to 40% your first year. Visit LifeLock.com/podcast for 40% off. Terms apply.
For your real life and real future, Tom and Don are talking real money.
Welcome back. Let's go out to St. Paul, Minnesota. Frank, you're on. Welcome to the show.
Good afternoon, gentlemen. I have some relatives, one an elderly relative, who is using a financial planning firm. The name of it is Prairie View Partners. They are, like me, located in St. Paul, Minnesota. I understand they are a fiduciary firm. They call themselves that. I understand they are fee only. And I know there's different websites where you can look up ADV or whatever, and you can give me some more information because if I understand you correctly, you start with having a fiduciary, but some fiduciaries are better than others.
Yeah, and some people
they're duly registered. They could be registered as a RIA and as a broker dealer.
What was the name of this one again? Prairie View?
Prairie View Partners, he said.
Partners. Prairie View Partners.
So, Don
really
gives out
curious.
the website regularly at the Securities and Exchange Commission where you can go get this information and look them up to find out what conflicts of interest they have, what they charge, etc. So
Prairie View Partners. Oh, okay. They've merged with another firm now. Okay, hold on. Let's see. Prairie View. They've merged with a company called Savant. And I'm trying to find their darned if they aren't true fiduciaries. There's a rarity. They don't come up very often. These guys are fiduciaries. They charge $2 million. I charge 1% of the first $2 million, and then they have a sliding scale after that, which is pretty typical. It's pretty fair.
I'd prefer a break at $1 million, but okay.
But it's very fair. I mean, we see them at 100 at 1.5, and
yes,
and so they do. They're a fiduciary. I can't say any more than that, but I am pleased to report that they are truly a fiduciary firm.
How do they manage money? What do they believe?
I don't know. I don't have that.
No, but if that's your question, Frank, then it appears that you were correct. Yes, sir.
Yeah.
Okay. Well, good to know. I want to keep an eye on my elderly relatives.
They use indexing and passive. They manage like we do. They manage like we do. Yep.
Yeah.
They manage just like we do. It sounds good. I give them a thumbs up. Now that doesn't mean that I know they're going to be any good. I'm just saying that your odds have improved dramatically over going to a duly registered firm.
Well, that's good to know. I'm sticking with Appella myself, but it's good to know my elderly relative is reasonably well taken care of at least.
They absolutely. I think that's absolutely true. I don't have any real big concerns about them. I don't know a lot about them, but from what I can read, what I know, what I see on their ADV, it looks like they're telling you the truth, and that is a huge difference between them and most other firms. They're actually telling you the truth. Thanks so much for the call, Frank. We appreciate it. Remember that number, 855-935-TALK, 855-935-8255. If you have questions any other time other than Saturdays, then go to talkingrealmoney.com and go to the contact form. And if you want to meet with one of our Appella Wealth advisors for free, for nothing, literally no sales pitch, go to talkingrealmoney.com.
The opinions and views expressed on this podcast were current on the date recorded. Opinions, estimates, forecasts, and statements of financial market trends that are based on current market conditions constitute our judgment and are subject to change without notice, including any forward-looking estimates or statements which are based on certain expectations and assumptions.
Although information and opinions given have been obtained from or based on sources believed to be reliable, no warranty or representation is made as to their correctness, completeness, or accuracy.
Information presented on the podcast is not personalized investment advice from Appella Wealth. The views and strategies described may not be suitable for everyone. This podcast does not identify all the risks, direct or indirect, or other considerations which might be material to you when entering any financial transaction. Past performance does not guarantee future results, and profitable results cannot be guaranteed. We hope you realize that the information provided on Talking Real Money is for informational, educational, and hopefully enjoyable purposes only. The podcast is not trying to get you to buy or sell any financial products or securities. Instead, the program is provided as a public service by Appella Wealth, a fee-only registered investment advisor.
Please see Appella Wealth's ADV Part 2A on our website for information regarding Appella's fees and services.
Appella Capital, LLC, DBA Appella Wealth, is an investment advisory firm registered with the Securities and Exchange Commission. The firm only transacts business in the states where it is properly registered or excluded or exempt from registration requirements. Registration with the SEC or any state securities authority does not imply a certain level of skill or training. Appella does not provide tax or legal advice, and nothing either stated or implied here should be inferred as providing such advice. Thanks for listening, and please visit TalkingRealMoney.com for more information and important disclosure related to performance of any specific index or fund quoted in this podcast. I think I need a nap.